Well, there's a lot of good news around for regional Australia at the moment. At least it appears that way if we can believe our independent politicians. Here's some other news which is not so good. First up, in many areas of eastern Australia, there's now too much rain. Rain means your crops will grow and your livestock will get a feed. But too much rain is giving birth to the following complaints. Fungal disease in the wheat crop. A boom in locusts. We'll have a report on that next week, incidentally. But from Nyngan in central New South Wales comes reports that a 3-kilometre long locust bed has been detected. And there's the looming threat of army worms. They love the wet. That army worm shot provided by the Queensland DPI. And you can't get on or off the paddocks if it's too wet, of course. I had one bushy complain to me the other day. She hasn't been able to get stock on or off her property since March. In other gloomy news, if you're thinking of giving your paddock a hit of urea, check the price. 6 weeks ago, urea was around $220 a tonne. You can expect that to go to close to $500 a tonne before Christmas. And expect the price of tomatoes to rocket in coming weeks. The reason? The June poisoning of 7 million seedlings near Bowen in North Queensland. Those tomatoes would have provided much of the current supply. That crime has yet to be solved, and there's a $200,000 reward on offer. But let's move now to the here and now, the markets for the past week. And starting with livestock. And here's another classic indicator of too much rain. Cattle supply at markets covered by the National Livestock Reporting Service down 32%. And the sole reason, it's just too wet to move stock. It was so wet, there was no sale at Winton, Blackall or Longreach last week. Elsewhere, numbers were very short and prices reacted accordingly. All categories went up. Cow buyers were almost desperate, pushing the indicator almost 9% in just 1 week. And with more rain around, it would be a brave man to suggest these prices will come back anytime soon. And this action lifted the Eastern Young Cattle Indicator by 6 cents. The live trade out of the north continues to struggle. Rumours abound about a looming shortage of beef in Indonesia, and there's rumours around too of some sort of solution to this problem. Prices have moved sideways. Steers and heifers are in demand, and again, no market for cows. And before I leave beef, the processors had their big day at the Gold Coast last week. It was the AGM for AMIC, the Australian Meat Industry Council. It was a strong roll-up of processors and manufacturers and a special overseas guest.
Our business needs to be run very simple, very dynamic.
Wesley Batista is one of the 3 sons running the massive JBS conglomerate, the world's biggest meat processor. Mr. Batista told the conference and Landline our rising dollar was making life tough for processors.
Oh yeah, definitely the strengthening of the Australian dollar for export, you become less competitive, definitely. But in my view, is not a question of Australia want a strong or weak currency. This depends a lot of the U.S. economy and how the U.S. dollar is performing around the world. So our view, like Brazil or Australia or Korea, these currencies will keep being strong, will continue being strong. So we need to adjust ourselves to produce product to live with this kind of currency.
But despite the dollar, Mr. Batista was at pains to emphasise there has rarely been a better time to invest in the beef cattle business.
It is about supply and demand. When you see supply around the world, we are not seeing, and JBS, we don't believe that we will see more supply and increase in production. When you see South American is not increasing production, when you see North American is not increasing beef production, Australia is not increasing, Europe is declining. And for us, it doesn't make sense to see Asia or Brazil or Russia and the Middle East, all these markets growing in a level that these markets is growing in terms of GDP, and don't see demand continue growing. So it's a question of supply and demand. And remember that the cycle, the cattle cycle is quite large. If demand is much stronger next year, the industry cannot produce more beef next year, because to produce more beef, you need to retain cows, grow the size of the herd. So we are very bullish because we believe that demand will be stronger than supply. We think prices will go up, and this will improve a lot margin for everybody, for producers, for us, and we think the industry needs this. Producers have been running in a very hard times. The industry needs to make money to be excited again, and we think this will happen.
And why wouldn't JBS be bullish? The competition watchdog has given the Brazilians the green light to take over the Rockdale feedlot and abattoir in the Riverina, and already they're talking about investing $80 million in upgrades. Moving on to sheep meat, where there's also a lot of confidence. Lambs were firm at $5.43 a kilo, while mutton slipped a fraction. Time now to look at grains, and this market is hot both here and overseas. Starting in Chicago, we saw soybeans, wheat and corn head north. Corn hit a 23-month high, while wheat heated up on the back of crop problems in Canada, and the soybean story remains Chinese, or at least Chinese demand. And an interesting sidebar story emerged when Germany was forced to buy American wheat for the first time in 3 years. It was the only country with available wheat. Local wheat rallied again, the market reacting to the overseas strength and local conditions. So wheat lifted $10, canola fell back in line with Canada, and sorghum was static. Lots of chatter around about a cracker sorghum crop coming up in late summer. Pro Farmer has an interesting take on hedging, suggesting farmers should hedge around 40% of their crop at the current price, with the only worry, unlike previous years, being possibly one of quality rather than quantity. Back to New York now for sugar and cotton. Sugar lifted after news that several countries are cutting import tariffs, while cotton traded sideways with traders anxious about what they consider is already a pretty high price. So cotton shed a fraction. That's still more than 30 cents up on this time last year, and sugar went up just under 2 cents. Finally to wool, which had a so-so week. Just over 37,000 bales were offered, and buyers from China were dominant, followed by Europe and India. The Eastern Market Indicator fell just under 1% to close at 876 cents a kilo. And that's the Landline check on prices.